Guys, a warm welcome. Sorry for being slightly off the time. Appreciate your patience. What we'll try and do, myself and Sanjay, who heads our research, will take you through in terms of what we think are going to be the defining themes for 2023, and we are okay to have questions even as we run through the presentation. I would rather want it to be interactive, which is fine with us, and then we can also have a question and answer session. So before I sort of get into the presentation, let's try and capture what happened in 2022. I think the big defining trends in 2022 was the fact that you had an unusual movement in bond yields globally, right? We have never seen US on bond yields move by 4.5 percentage points in a short period of time, which also meant that you had an unusual movement in DXY, or the dollar strength, and I'll talk about it as we move along. A 20% move in DXY is unheard, right? And I think we have come across very well despite the global headwinds. Third thing, obviously, which is still lingering, is the war on Ukraine, and which all of us thought that would be a cakewalk for Russia. But then history tells us again and again that it's easy to start a war. It is very difficult to stop one. And now when you go and look forward into 2023, I think a lot of these things will reverse. So I think we are looking at a situation where things will mean revert as you move forward. And first, the most challenging part for us has been inflation. Amit, just let's move to the next slide. Yeah. So again, move forward.
Neeraj,
your
is turned off. Can you please turn it on?
Sorry?
I think your video is turned off. Can you turn it on?
The host will have to,
Nidhi, you'll have to enable it. Right now it's
please enable my video.
One.
Nidhi?
Yeah, Neerav, Amit is doing that.
Yeah. So the host will enable this. Inflation, I think we are pretty clear that, we are behind the worst in terms of inflation. We want to call it peak inflation. We don't know the pace of the moderation, but if you look at any of the high frequency indicators, whether it is the container rates, whether it is the dry bulk rates, whether it is the semiconductor issues, whether it is the agri prices, or whether even if you look at commodities, broadly most of the things are down 15 or 20%, 25% from the peak. And please appreciate the fact that inflation is a YOY phenomena, right? It is not an absolute level of prices, which means that as we move forward into the next year, our own expectations are that we'll probably get to about 5.5% by Q4. RBI's own expectations are about 5% in Q1 as we move forward. So inflation, and to me, the biggest risk to equity markets over the medium term and the long term always remains inflation. And I think you've done a phenomenally good job in terms of controlling inflation, given what the developed markets have been facing all this while. And to some extent, I think that reflects in the resilience of the markets as well. And like I said, I'm happy to take questions around this, but I think we are very clear that we are past that phase of inflation. I am not a great believer of what is usually called this the labor price spiral. It is not there in India. It is not there in US. In US, when you go back into 1980s, the unionized labor force was close to about 30%. Today it is less than 11%, right? So while the Fed has to be more vocal in terms of trying to rein in inflation expectations, I think we need to read between the lines. And I won't be surprised, for example, if Fed would be done with most of these rate hikes, probably one more rate hikes to come in February. We'll have 2 more inflation prints coming by then. And I think then they'll probably pause, and depending upon how the growth numbers play out, may even start cutting the rates later in the year. So you're past that steep curve of interest rate increases. Amit, next slide, please. These are about the earnings that I talked about. We track this labor hourly earnings. But like I said, the key takeaway for you guys is essentially the fact that it is not going to be a circular problem. Inflation is not going to be a circular problem, not in India, not globally. Move on. I just want to catch the high parts. So this is interesting. It basically tells you that every recession itself is a disinflationary phenomena, right? So we don't know how long. So what are the odds of US getting into recession? Very difficult for us to make a case. It is slightly technical. So I don't want to get too much into it. But if you believe that the supply curve in US is steep, which we believe, that means that you will have a very, very low pullback in aggregate demand for inflation to come down, right? So at least that is our base case, but we'll have to see as more and more data points come across. Next slide, please. I just referred to this about labor price and the wages not moving in tandem. Next slide. DXY. Next slide, and I'll spend some time over this. This is important. How dollar moves is very, very important, because if I need to explain this to you, these sort of dislocates our own monetary policy to what the economy demands. So if you have a situation where DXY rallies strongly, which means that people then try and sell emerging market currencies, which means that you start losing liquidity, which means that RBI will have to increase the interest rates to defend rupee, which means that even if my economy cannot take high rates, I'll have to face those high rates, right? So that is obviously, so you are, even today, you are a pillion rider, right? And US obviously has the benefit of being what you call the owner of the reserve currency, right? Why did we escape the problem that we faced in 2013 QE taper, right? There was a big chaos. We had current account deficit problems then. We had current account deficit problems in the current year. We barely nudged. And the reason for that, our starting liquidity, if you go back in Jan, Feb, our starting liquidity at the repo window was 8 lakh crores. Which means that you could absorb 30, 40, $50 billion of money moving out of the system without impacting the liquidity in the system, right? And if you actually read, yesterday RBI's deputy governor has given a very nice interview and talking about the fact that we should look at surplus liquidity raw, even when we are raising the interest rates, right? So she has made a case for that. So it is very important. But like I said, to us, we are done and dusted again with the strength in the DXY that we have seen. Amit, next slide, please. Different emerging markets are going to be hit differently depending upon the stage of the economic growth. But it is suffice to say that if Fed is behind the steep increase in rates, then we are behind the strength in DXY. It doesn't necessarily mean that DXY will have to fall. It can be a sideways movement. It can even fall. But as long as it doesn't rally very strongly, we are home. Next slide, please. What does it imply for India? Next slide. So the most critical thing, and like I said, you guys will have access to the presentation. I think the key takeaway for us is that we are not firing as well as the other developed markets are, right? So even today, when we look at it, we are just about 5% above our pre-pandemic GDP growth estimates. We are below the trend line. We did not overstimulate. We have not seen, inflation getting out of control like what you've seen in other parts of the world. To that extent, we don't necessarily have to tighten as much. And I think RBI governor has done a phenomenal job so far, right? While trying to, so it's a very fine balance, right? So because you also want to build your credibility, you don't have 30, 40 years of credibility like Fed has got, which means that when you talk, people should take you seriously. When I talk about not investors, not only necessarily investors, but public at large, which means that you need to rein in inflation expectations. At the same point of time, you don't want to increase the rates because you want to protect the growth. And I think so. My own personal view is that my economist has probably a different view. I won't be surprised, for example, if we are done with increasing interest rates, right? And obviously, we'll have to see in terms of incremental data points. I'm not too worried about inflation. I've talked about it, right? I also believe that Fed is at fag end of his interest rate increases, and I don't think we need to increase our interest rates from where we are at this point of time, because we still have a very, very clear K-shaped recovery. Urban is doing very well, rural is not doing well, right? And you don't want to tilt the balance right now. So you just want to drag, you want to drag out these global headwinds that you are facing right now, and then take control of your monetary policy again. Next. Here we are just talking about the channels of inflation. It can happen through exchange rate. It can happen through credit growth. I only tend to look at credit growth. Next slide, please. Can we pass this slide as well? This is important. The channel through which inflation actually gets into, through lower interest rates is to credit, right? For the first time, we have seen credit growth picking up. We are just coming out of decadal lows. And then also you need to sort of temper that with the fact that your real credit growth is lower because you had a very high inflation rate to start with, right? So you try and deflate that by CPI and see what is the real credit growth rate. So we are very early in the cycle, and which is why one of the case that we make that RBI should be far more cautious in terms of raising the rates further, because I don't think that inflation is our worry at this point of time. It is time to refocus back on the growth itself. Next, please. Next slide. Our estimates are at 5%. RBI will stop at 5.75. Maybe some of the market expectations are at 6.25. I don't think that 15-25 basis points makes too much of a difference, as long as we know that we are coming to a pause more than anything else. Next. There is a bit of worry that you've got. So you've got, broadly speaking, your three elements of growth. You've got consumption, which is urban and rural. Then you've got investments, which is government, state and center, and private corporate capex and the real estate. And then you got exports and imports, a summation of that, right? Export is something that we are genuinely worried about, because obviously you are not immune to what happens globally. And therefore you again fall back on the same argument, which is whether you will have a short recession or you will escape a recession or you'll have a longer recession. We don't have answers to that so far, but it's fair. It is just wise to model that you will have some drag on our own growth rates from what is happening globally through the export channels. Next. Indian markets, people tend to look at emerging market peers. We have done very well. I will not overemphasize emerging market peers, because China has done what it has done and it enters into that basket, and therefore the valuations and they look pretty high. It is like looking at Bajaj Finance valuation as compared to Punjab National Bank, right? So one is a PSU, one is a private sector. So is India vis-a-vis China. So you need to adjust for the fact that the regulatory risk in China are significantly higher today than what they were 2 years back. Next. Our starting points are not too great in terms of the valuation. We need to be cognizant. So we are very bullish, but that doesn't mean that you blindly buy the markets. There are a lot of bottom opportunities. Sanjay will talk about that. But relative returns will moderate, because obviously some of the other countries have become very cheap as well, including what is happening in China. Some of the near monopoly sectors are trading at single-digit valuations. So the relative returns is what you are referring to over here. Next. Growth outlook, I just referred to it quickly. We talked about the problem in the rural markets. We are bullish on the investment cycle. all the three legs that I referred to, including real estate. Next. Sanjay, you want to take over from earnings?
Yeah, Nirav. Okay, before we head into what we are thinking of Nifty in terms of earnings outlook, where we are currently on valuations, just want to summarize, you know, why the markets have done well in the last 12 months for us. I mean, obviously India has stand out in terms of resilient GDP growth rate. Also importantly, the growth differential vis-a-vis rest of the world, that has been fairly high. We have seen growth estimates, forecast being cut everywhere, even for India. And we are not done with the cycle overall, whether for India, rest of the world, but the growth differential remains quite high. And that has been helping India vis-a-vis rest of the world, particularly the EMs. We have seen very healthy growth in corporate earnings, low teens growth this year after a very strong growth in FY22. And inflation control has been pretty good in India. But most importantly, the domestic equity flows have been very robust, and they have, very handsomely absorbed a lot of the FII selling which has happened, particularly in the first half of the year. And although it started in the third quarter of 2021. So these are some of the reasons, and now we are already seeing some reversal of FII equity outflows as well, and that is supporting the valuations, which are not cheap, and I'll come to that later. Just also to summarize the outlook on the macros, yes, there will be some more interest rate hike, particularly in the US. We may also see another 25 bips hike, although inflation is well in control. So that our outlook is that next year inflation will be around between 5.5%. 10-year GSEC yields, they've been uncapped. They've been below 7.5% for over 6 months now. Currently 7.3%. We don't see any flare up over there now that we are ending the interest rate hike cycle. Fiscal deficit also remains under control, should come at under 6.5% of nominal GDP for this year, fiscal year, broadly in line with what the government has targeted. Current account deficit, not very different from consensus. Our forecast is around 3.5% of GDP, $120 billion. BOP will be negative, $50-60 billion. It will be negative in FY24 as well, but it will be closer to neutrality, compared to this year. A lot depends on the extent of capital, inflows next year. Finally, on the rupee, it has depreciated, and I would say, to some extent that may help why some of the FII flows have reversed. So the interest rate hike in the US has been quite aggressive, as Nirav mentioned, more than 400 basis points within a year. And whereas, RBI has raised the repo rate by 225 basis points so far. So we have been lagging on the interest rate hike, partly because the inflation has been lower, but some of the brunt has been borne by the rupee, which has depreciated, and that now we don't see significant depreciation in the rupee. Much of that is already done. So these are our broad macro views. Overall, if you look at the macros, Indian macros are worse off compared to the pre-pandemic level, but at the margin things are improving, and that is the good news. On every front, whether you look at CAD, inflation, BOP, INR, at the margin things are improving. Certainly, they are not worsening. That is what one can say. From a near-term point of view, I think the only two issues. One is a little bit of interest rate hike which is left, right? We are going to approach the peak repo rate very soon by February, around 6.5%. And at the margin, growth forecasts are still being trimmed. If you look at last RBI forecast which came out in the MPC, 6.8% real GDP growth for fiscal 23. And I think we started the year before the Russia-Ukraine war broke out. We were around 7.5%, a little more than that. So growth forecasts have been cut. And that is a near-term issue, I would say, for India, particularly in the context of what is happening globally, in terms of the recession fears, growth slowdown, and that is going to impact India also at the margin. Perhaps most of that is already reflected in the forecast, but we'll have to wait and see. And that's a near-term issue. Also, rural recovery has not been still subpar, and as again Nirav mentioned, is a K-shaped recovery. But yeah, I mean, ahead of election, perhaps government will take care of some of the, maybe there'll be stronger rural spending, and that can lift up the sentiment next year. But that remains an issue. Urban consumption has been very robust. A lot of it is pent-up demand post, full reopening after COVID. But again, high inflation, interest rates hike, they tend to impact consumption also with a lag. So again, that's a very near-term issue. We are very bullish from on a 12-month horizon and beyond that. But on the next 3 to 6 months, we may have to see how corporate earnings pan out, particularly on the consumption, discretionary consumption front. So this is the broad sort of a macro backdrop in terms of which is guiding how we are looking at the market. Now, coming to the Nifty earnings, if you look at the slide, this is slide number 24, I think. Yeah. So as I mentioned, this fiscal year, we're expecting Nifty earnings, Nifty 50 EPS to grow at 13%. But next year, it's much better. A lot of it is coming from banks and the fact that the auto sector cycle will continue to gather steam. And also the fact that some of the sectors which are suffering from high inflation in terms of margin pressure this year on the consumer side, they will start doing better as the commodity prices have come off. So that is going to help. So that's why there is a stronger growth projected for FY24 in Nifty EPS compared to this year. FY23 EPS since the beginning of the year has been cut by 4-5%. Okay, since the Russia-Ukraine conflict broke out. FY24 EPS has also been trimmed, but by much lower amount, 3%. So at this point in time, we don't see material risk to FY23 earnings. There is some risk to FY24 earnings. Consensus forecast is 18% growth YOY. This may be a bit lower, but the chances are pretty high that the growth next year in EPS for Nifty will be better than this year. Some risk, as I mentioned, global growth slowdown, some impact on the domestic consumption of monetary tightening and inflation this year. So this is the forecast for growth. On a 2-year basis, if I look at CAGR, we are looking at a mid-teen earnings growth for Nifty this year and next fiscal year. If we go to the next slide, a lot of the Nifty earnings in previous year, FY22, if you look at the table at the bottom left, this came from low PE stocks, commodity stocks. They really rallied, particularly in the second half of last fiscal year, and that contributed to Nifty 50 earnings growth significantly. Having said that, the earnings contribution of the high PE sector, some of the secular growth sector, and some of the growth cyclicals also, be it auto, banks, it was quite robust last year as well, 32%, and this year we're projecting 27%. So on a high base, of course, the growth rates are coming down, but quite handsome. But the low PE sector, the commodity, metals, oil and gas, those sectors are going to see an earnings decline this year as commodities have cooled off. So the bottom, the sum, total of all this is that the Nifty, the quality of Nifty's earnings growth, that is improving. More earnings are coming from high quality sector, high PE sector, growth sectors compared to the low PE sectors. So that is improving, that is normalizing from FY23 onwards. So that actually is a case for supporting higher Nifty PE multiples because the earnings quality is improving. Okay. Can you go to the next slide, please? Yeah. Yeah. So this is how the Nifty earnings. So we talked about earnings growth and earnings outlook, earnings mix. If you look at the valuations, they are not very comforting. We are very close to 20 times. Look at the chart, at the top right, 20 times forward price to earnings. Last 10-year average has been 16 times, and last 15-year, I think there's some swapping here. Last 15-year is 17.2 times, not last 10-year. Last 10-year is 16 times. So last 10-year, the PE multiples, average PE multiples have improved. Yeah, so sorry, this is correct. Last 10 years, 17.2. There was an error in my presentation. So from 17 versus 17.2, which has been the average for the last 10 years, we are close to 20 times. And in that context, the multiples are expensive. The current multiples are actually one standard deviation higher than the last 10 year. So they're not very comforting. Earnings growth outlook is good, but the valuations are already sort of pricing in a lot of that. Our view is that broadly, market multiples can be higher than last 10-year average. Okay. Because India does stand out, domestic equity flows are robust, and there's a lot of cyclical sector which are going to do well. And earnings growth outlook is quite good actually. We're talking about 18% at the consensus level, but even with some cuts, it will be higher than this fiscal year, which is projected at 13%. So that's a very good earnings growth outlook. So multiples can be supported higher than last 10 years. Whether they'll be 19 or 20 is difficult to say. I think that will be an optimistic case in my view. So if we look at multiples being somewhere around 18 and a half or so on 2024 earnings, then by December 23, we should have Nifty somewhere around 19,500. I think that, and we are going with that as a base case. Multiples slightly higher than last 10-year average, but lower than where we are currently. So we are actually looking at, in our base case, some PE derating to happen for the market over the next 12 months. Okay. In the bull case, if the multiples were to sustain here, FII outflows sort of structurally sort of reverse in a convincing way, domestic inflows remain strong, we could be at 19 and a half, 20 times as well. In that case, the Nifty 50 could be at 21,000. That's the optimistic or the upside case in our view. And if we look at the downside, let's say Nifty were to trade back at last 10-year average multiple, which is 17.2, then we are looking at roughly 17,500 as Nifty in 12 months time by December 23, which means some downside, but not a whole lot. So overall, we still feel the risk reward is favorable. In our base case, Nifty will deliver single digit return, around 7-8% over the next 12 months. And that assumes some derating from current levels. So next slide, again, we looked at the Nifty's multiple in a slightly different fashion. Looking at Nifty's earnings yield, inverse of the PE ratio, and comparing it to the 10-year bond yield. And we find that the gap is much lower than historically, around 200 basis points is the gap. So which means relative to the bond yields, the equity markets are slightly expensive compared to 10-year average. So just reiterating the same points that compared to historical averages, the markets are trading on a slightly higher side. And that is exactly the reason we have assumed that the PE multiples will derate from here over the next 6 to 12 months. So I don't want to spend too much on time on this. Nirav did mention that, Indian market have traded historically at a significant premium to MSCI EM. And currently there is even stronger case for an even higher premium for Indian markets vis-a-vis the MSCI emerging market index. And that is already the case currently. The markets are at a higher premium compared to historical averages. Coming to the sectors broadly that we favor in this environment, we have given a sense of where we are sort of more bullish. So essentially on an overall level, at the Nifty level, we're bullish on banks, particularly private sector banks and some small cap banks also. We're bullish on autos. We think that the cycle has legs and this will continue, particularly on the CV side. It will continue for another 2-3 years. We are still in early stages. We're bullish on insurance, secular growth story. Cement and building material, this flows from the fact that we are bullish on the capex cycle. We think it's a matter of time before the private corporate capex also picks up. The capacity utilization levels are high for the industry, and there is still momentum on the housing front, and central government capex remains strong, even though I would say state government capex has been lagging, and they may not meet their budgeted numbers. But central government is certainly on track to meet its capex budget for this fiscal year. So that explains our view on cement and building material. We're also bullish on engineering and cap goods and to some extent on telecom. At the overall level, we are still underweight on IT. And that's again, this has, IT sector has underperformed Nifty. IT is down 25% this year. It is still hostage to recession fears in the DM. Much of that is, priced in our view. And therefore, we believe that some point in time in the next 6 months, IT will become a strong buy. But I think we are waiting for the earnings estimate, whatever left is there in terms of recession impact to be cut and US recession to play out over the next 6 months. But currently, we still remain underweight overall, but we are broadly neutral on the large cap IT names. We are more negative on the mid cap IT names, which we think would suffer more in case of DM recession.
Sir,
And
the question from Nikhil Valavalkar. He's saying that credit has grown by 17.5% in December, whereas the deposit increased just by 9%. So are banks going for raising debt? How do you see this development?
So yeah, I mean, it's see the way we are looking at this phenomena is that asset repricing, the loan book repricing is still happening, because just remember that we are still not done with the rate hike cycle at the repo rate, right? So a lot of that repricing will continue to happen, and that is going to help the net interest margins of the banks. Having said that, the deposit growth rate, the liability side repricing, increase in deposit rates, that happens with a lag. So yes, maybe there's 1 or 2 more quarters to go for NIMs to sustain and maybe even grow. But yeah, once we get into FY24, NIMs are not going to increase anymore, right? And I think a lot of that is already reflected in the numbers. So I don't think people are extrapolating what has happened in the last quarter, where we saw improvement in every parameter for the banks: credit growth, NIM, OPEX ratios coming down, provisions coming down, those kind of things, non-interest income also rising. So yes, the net interest margin is probably the first area where first metric which will start normalizing in the next couple of quarters. But certainly the 3Q and 4Q, we still expect NIM to either improve or remain the same. So what you're saying will probably play out early next fiscal year. Does that answer the question?
Add here, you should not get too carried away by the narrative of deposit growth, lagging credit growth, and all that. The way to look at it is that the only way to create new deposits in the system is to credit. Everything else is just moving around, right? When you are increasing the rates of the deposit, you are trying to ensure that people stop consuming less and increase their savings, and therefore to some extent more money in the bank. But the real impact on the deposit can happen only via credit, because that is new money that is being printed. Every time you write a loan, you are creating new deposit in the system, right? So I am not too worried about the fact that my deposits are lagging behind. As the credit growth picks up, so will the deposit growth rate. You are not going to run short of deposit ever, even if your saving rates are low. It has never happened in any other country.
Yeah, thanks, Nirav. So at the system level, deposit growth will happen, and it should improve, because it tax along the credit growth as well. I think liquidity also has to be ensured adequately in India, because FII outflows, we're running a BOP negative situation. So the liquidity injections are important to ensure that we don't get into a situation where the deposit growth or the cost of funds rise significantly. So that's, I think, RBI probably that's in the domain of RBI, and I think this will be ensured over time.
You got more questions anyway, so in the interest of the time, I think I saw someone raising a hand.
Yeah, so I'll just finish off the last slide here. So we talked about the large cap portfolio where we are bullish. I'll just quickly cover the small and mid cap also portfolio that we run for our clients. Small mid cap portfolio has significantly outperformed the underlying indices that we track. In the last 2 years, our small mid cap portfolio is up almost 120%, whereas the benchmark BSE 400 is up 55%. So here we are more bullish. It's a more eclectic mix of stocks and sectors, but some of that is flowing from the themes that I talked about. We are bullish on consumer discretionary, the QSR, apparel stocks, auto ancillary against on a select basis, and also some of the value stocks where we see on the utility side, be it CESC, some of the banks, private sector, small mid cap private sector banks, which we find still attractive. They're cheap. Karur Vyasa Bank, Canara Bank, also Equitas is also there. So this is a mix of stocks, and these overall these stocks have done well, and they just play to the themes that we are backing at this point in time for next year. Yeah, you can take more questions now.
Friends, any questions, please feel free to unmute and or maybe type it out in the Q&A section.
Hello,
Yeah.
am I audible?
Yes, you are.
Yeah, I just want to know that first thing that you said that deposit to grow, credit growth is important. So I could not understand. I would like to need a little more explanation on this. And second question is, will you also comment on this ongoing development in which rupee ruble trade is being developed? So are banks ready? I am told that banks are reluctant, Indian banks are reluctant to go for that in the given scenario when dollar still reigns supreme. So I just wanted to understand from you on these two fronts.
Okay, can I have your first question again? I missed that.
No, you had already explained that for deposit to grow, credit's growth must happen. So I could not understand how are you saying that?
See, what I'm saying is that how do you create new deposit in the system? Right? I'm saying what I'm referring to is a concept of money multiplier. नया पैसा system में तभी आएगा. So let's say, for example, I don't have money. Let's say I take a loan of 15 lakhs from State Bank of India. State Bank of India will credit my account with 15 lakhs. That is new money. That money was not there before I took a loan. So that eventually will reflect as a deposit. And so it is slightly technical, but the point I'm trying to tell you is that outside that, the way to create new deposit is by creating a new credit. That is only genuine way of creating new deposits. Or when, for example, that is what happens when you buy. Let's say, for example, when RBI is buying dollars, it is printing money. When it is printing money, it is some way creating new deposit in the system or the liquidity in the system. So outside that, if you still want the deposit rates, your deposits to pick up, then you have to influence my spending behavior. That is where the interest rates come in. That at any point of time, you are telling me that, okay, I'm going to increase the interest rates, and therefore I am likely to consume slightly less and then probably try and save something more. But I think we are very, very, the point I'm trying to make is that even at 6.5% deposit rates, I don't think it's going to materially change the consumption metrics, is the way at least I look at it. And you had a second question.
Yeah, I had already told. Could I repeat it?
Yeah, it was about
yeah. So I would like to know from you that when in the current scenario, when the rupee ruble trade is being promoted, so but I am told that Indian banks are reluctant because they know well that the dollar continues to reign supreme in the international, market. So how do you think, how will the rupee ruble trade will see the realization of the dream?
No, so I don't think it's a question of whether it is not a natural natural mechanism, right? So why would you want to take rubles? Where is the market for the rubles outside Russia? So it is natural that there is reluctance. The fact of the matter is that if I am going to buy oil at a discount from Russia, and if I have to bypass the sanctions that US has put in place, therefore there I need to get to a system where I can take rubles or I get into some sort of barter arrangement. But this is because you want to evade the sanctions. That is not a natural way of conducting transactions because the ruble doesn't have any liquidity.
But there are bottlenecks, no? Is it possible? There are bottlenecks.
It is possible, but I'm saying, so you are buying. So if you sell something, you will get rubles. You'll use that rubles to buy oil. I don't know right now whether we are certainly running a trade deficit with Russia if we are in effect importing oil. But you will try and balance that deficit. So जितना आपको रूबल में खरीदना उतना आप रूबल उनसे
Here I have a question, sir, that our import is 5 times more than we export to Russia. So
exactly.
there is much not mismatch. And
Absolutely.
secondly, rupee is not yet still full floating. So could you kindly throw some light on this aspect?
No, so I'm saying is that there is no other option. So I'm saying is that you will still have to pay them in rubles, or you have to figure out a way to bypass the some of the banks and conduct in dollars.
Yeah, so I think the trade has to move towards some sort of a balance, okay, for this thing to be viable on a sustainable basis, because with otherwise there will be imbalance. There will be surplus of rupee somewhere and surplus of ruble somewhere, and that I think is not desirable from banks' point of view. So there is reluctance among banks at this point in time to
Got
expand
it.
this rupee. Yeah.
Got it. Thank you.
Thank you, Nikhil. So we have Sundar Sethuraman, Aparna Iyer, and questions by Nachiket Kelkar as well. So Sundar, please go ahead with your question. Okay, Sundar, can you hear us? Okay, while at it, Aparna, can you go ahead with your question? Okay, we have Sundar. Sundar, you're unmuted. Please go ahead with your question.
Yeah. So the question is, what is your outlook on the FPI flows? That's number one. And we are in a scenario where the debt returns are looking attractive vis-a-vis equity. So what are your thoughts on that? Yeah.
So FDI flows, I think we had a very unusual year, right? So it certainly will be better than what you have seen in the last year. And for me, that is good enough, right? So you lost about $25 billion. And that is largely explained by the fact that you had a 20% increase in DXY. Now that is reversed. And like I said, see, just think about it. We get too focused on what's going to happen in the next 3, 4, 5 months. We did a comparison of top 10 countries market cap in the world. India is at number 6. If I look at top 5 countries, their average GDP growth rate is about 2.7%. If I take China out, their growth rate falls to 1.7%. If I look at 4 countries below me, the average growth rate is 1.7%. And out of top 10 countries, 3 countries are not even democratic. If we don't do anything, we'll grow at 5%. If we run the economy well, we'll grow at 6.5%, 7%, even at 8%. So that differential is huge. So where the money, see, the question is that the money eventually flows where money is to be made, no? It has to come. It is like, when you ask me about SEEP inflows, it is a behavioral change, because you have not seen Nifty give you negative return on a 3-year rolling forward basis ever. So once people get conditioned to the fact that if I take a slightly long-term view, that if I stay invested in the market long enough, I end up making returns, right? That is what people, so that is how people shift. That is how the behavior changes.
No, I was asking specifically about next year, in a year when some of the other markets are looking cheaper, and even your report says that we are at a slightly elevated valuation compared to our 10-year average. So how much flows from the foreigners can we expect, and how much investors will the incentive will the domestic guys have when my FD returns is looking equally, if not more attractive than the the index returns? So yeah.
So
I think Sundar, let me can I make a point here?
Sanjay, let me just complete this. See, broadly, please understand that it is not binary. It is not that I put all my money in equity. It is not that I put all my money in debt. Likewise, like I said, this year in terms of FDI or FI inflows will be better than last year. Last year, we had an outflow of close to about $25-30 billion. We could get $10 billion, $15 billion, $20 billion. Maybe China can take in more. But when I talked about the fact that your growth rates are also higher, no? So no one knows, frankly, no one knows exactly whether we'll get $10-15 billion. But the point I'm trying to make is that think of it that my savings are increasing every year. And every year, India will eventually end up getting a higher percentage of their savings into the country. GDP growth rate next year will be higher, Yeah, it was supposed to grow at 5%, it will grow at 4% or 3.5%, which means that nominal GDP growth rate globally will be about 6.5, 7%. उतना savings बढ़ेगा, उतना part India में आएगा ही आएगा.
I was not asking for a number, but a broader trend.
Yeah, so trend is that I have no doubt about it.
Yeah. Okay.
So I think in short, if one has to understand what might happen, you have to see what is changing at the margin. What happened in 2022 was, the DXY appreciated a great deal. US economy is still strong, right? No recession in 2022. And number three, the real yields in the US, they shot up. We were running close to zero, less than 0.5% real yield. Currently, we are still running 1.5, 1.6%. That's the real yield on, a 5-year government bond and the 10-year yield, 20-year yield, 30-year yield. We're running, US is running 1.6%, offering 1.6% real yield. Now, if you go to 2023, next year, what is going to change? DXY is already depreciated. That is one. The real yields are peaking. There is still bit of Fed rate hike, which is happening, which is going to happen, but that is already priced in, in those interest rate curves. So real yields are peaking. And thirdly is that we are actually staring at some sort of a softening of the US economy and worst case, a recession in the US. So which means the growth differential of India versus US, even or DM or rest of the world will actually increase. So growth is going to be a big driver of capital flows this year, for India in 2023. Only, argument against that is that, market is still expensive. But I would argue that market is less expensive than 12 months ago or 15 months ago. When the FII outflows actually started, late 2021, the market was at 22, 23 times forward PE. We are still expensive, but cheaper than that. We are under 20 times. We are between 19.5 times or so price to earnings. So other than the market multiples, every other factor seems to be suggesting that we should have, good FII flows next year, certainly better than 2022.
Okay.
One more thing, one more question. You have use the term lagged impact of tightening as one of the headwinds. Can you explain that? What do you mean by lagged impact of tightening?
So when I meant was that, we've seen very robust growth in discretionary consumption this year, particularly in the urban areas. Rural has remained weak. That is well known. Now, but we have also seen a lot of the interest rates hike this year, right? And that's feeding through in the form of, higher mortgage rates, higher EMI expense. And also we have seen inflation, so maybe some of that demand was robust because, there was a pent up demand effect post reopening, for the first 2-3 quarters of this year. Our channel checks are indicating that, some of that demand is actually softening now that festival season is over, the pent up demand is over. This is a very near term issue. It's not a very significant issue. It's not a cyclical slowdown by any standards, but we have to watch out for some impact on the corporate earnings forecast because of this factor, and we'll get to know more of that when the companies declare their third quarter results and the fourth quarter results in the next 6 months.
Okay.
Is that clear?
Thank you. Thank you.
Yeah, a question from Nachiket Kelkar. What's behind the underweight view on consumer staples? And what's your view on PSUs given the rally that we have seen this year?
So consumer staples, our portfolio is still aligned to, growth, secular growth and cyclical growth stories. Now, consumer is a secular growth. Our worry there is, mainly twofold. One is that multiples are still quite expensive on the higher side compared to history, but earnings growth will be there. But we believe that a lot of that is priced in. The commodity prices have come down. Margin expansion we'll start seeing, from fourth quarter this fiscal, if not the third quarter, right? But a lot of that has already led to rally in the stock prices. So at this point in time, maybe it can be thought of in the near term as a place to hide, but certainly on a 12-month horizon, we'll be better off, overweight on the growth sectors, cyclical growth sectors, which are still cheap, as I mentioned, some of the banks, auto names. Yeah.
So the second question was on PSUs, given the rally that we have seen with the PSU companies. So what's your view on the PSUs?
So one could still be, bullish on some of the select PSU banks. Okay. But it's of course the larger PSU complex has also benefited from cheap valuations. And a lot of the value stocks have done well. There is still some story left in some of the stocks sectors, be it on the energy side, utilities, and some PSU banks. But our broad view is that by and large, a lot of that is done. And, it's very hard to re-rate the multiples more. I mean, because the PSU, the concerns on quality will come back at some point in time, right? So there cannot be indiscriminate run in the stocks next year, in our view. But some select names still will be bullish on the banks front and on the utilities front.
Aparna Iyer, would you want to speak up your question? You've typed in as well. So if you want, you can unmute and ask question. Aparna?
Hello.
Yes, Aparna, please go ahead.
Yeah, so my question actually has been partly answered in the previous one. So my question was basically on PSU banks. I mean, they have made a spectacular comeback this year. We have seen the valuations and the re-ratings that has taken place. But my question is, do you see a structural advantage for them? Or is it, are we still having the same issues that we always have when it comes to PSU banks with their risk management and do you see any structural advantage after how they have performed in the last couple of years?
So let me take that. See, there is no doubt that, things have changed. So underwriting is far better. And please understand that, things were different 5 years back, 10 years back, 15 years back, right? Media is far more agile, it's not very easy to do phone banking now, right? So there is no doubt. And obviously people also learn, right, from their experience in terms of what is happening, what works, what doesn't work. I don't think that we will have issues regarding the underwriting risk. I think the biggest challenge that the PSU banks will face, and which doesn't structurally change, is access to talent. And we are talking about next 5, 7, 8 years where digitization and technology will be a dominant theme, even for banks, right? Use of ML, AI, stuff like that. So I think why only banks? I think most of the PSUs will eventually struggle to compete with the private sector. But that is something that will play out over the next 3, 4, 5 years. If you ask me over the next couple of years, you've got an unusual setup, right? See, please understand the fact that banks have not taken risk in the last 5 years. If you look at their risk-weight assets to total asset ratio, it is down 10 percentage points. Everyone wants to write loans only to A and above. So what you're going to see is that you're going to see credit pickup. What you're going to see is credit costs not coming back for a long time because you've not taken risk in the past. So at least for the next 18 months, 24 months, I feel very confident that, the rally will continue because the earnings will continue. Please understand that PSUs have done well because the earnings have done well. Go back to 2003 to 2008. PSU banking index and private sector banking index gave similar returns because the earnings were similar.
Okay, any more questions? Please feel free to unmute or type it out.
I have a follow-up question. Within the PSU banks, some clearly have advantage because, the kind of business they did even before bad times were reasonable versus some which went awry on underwriting risk and etc. If we keep aside the secular problem of talent and technology, which seems to bog every PSU bank, if we pit them against private, which are the names that you would want to have an eye on?
So obviously State Bank of India, Bank of Baroda, Indian Bank, I think Sanjay mentioned about Canara Bank. There are a lot of well-run banks as well within that space. So, and like I said, I'm not even casting an aspersion whether some other banks are well or not. These are the banks that we cover. I still believe that the overriding theme is the fact that banking system is very well placed. Everyone will benefit. Just like when things go bad, when it rains, everyone gets wet. This is exactly an opposite of that. If you are
I
a
think
part of the
this
banking
is,
system today, you will do well.
yeah, and also I think a lot of this is what is already happening and will continue to happen for PSU banks as well. There's a rising tide is going to lift all the boats. The credit growth when you're looking at 17-18%, that is, there is no way there will be so much of divergence between private and public sector banks, especially because public sector banks, the starting valuations were quite cheap and the balance sheets were in good
Right.
shape. Provisioning was good, so there was that rally was waiting to happen. Yes, we kept on waiting, but only when the credit growth really picked up, that's when this tide started lifting all the boats. And I think that is going to continue for a while in some of the names which Neerav already mentioned.
Right.
Actually, PSUs may have some of the advantages. Some of the larger PSUs will have an advantage because the corporate capex is going to kick back after 10 years. And that
Right.
is where the ability to write a 10,000 crore check or 15,000 crore check is largely there with the PSU banks.
Okay.
Okay, Sanjay sir, there is a question from Malvika. What's your outlook on INR and what are the reasons why you think INR may be depreciating? Maybe done depreciating rather.
Yeah, so our view is that INR is largely done depreciating. Maybe in the short term, there may be some depreciation because the real yields in the US still remain quite positive and attractive. And there is more Fed rate hike, which is going to happen than the repo rate hike. So to that extent, there could be some more depreciation, but in the near term. But I think, once you look beyond 3-6 months, I think there is a good reason to believe that the rupee, there will be a pullback and there would be some appreciation because India's this growth differential is going to become even more attractive. And some of that is linked to the fact that we believe the capital inflows next year, 2023, outlook is better than what has happened in 2022. So, and also the fact that oil prices are under control in check, so there's been improvement in CAD as well as capital inflows. So on both these fronts, and the fact that growth differentials are going to be quite good, we should have some pullback in the rupee, if not in the next 3-6 months, then beyond that. The next 3-6 months, there is still some more rate hikes which are yet to happen in the US, which are higher than what we are expecting in India. Neerav, you want to add?
No, I sort of concur with your views, so we're on the same page.
Okay, so any more questions? Please feel free to unmute yourself.
I have one last question actually.
Yeah,
This is on the
yeah.
primary market actually, the way IPOs have come and performed after listing, at the listing and so on. Did you find any common thread as to how, like some IPOs have done well, some have not, but on balance, everyone has suffered because the broad market has been adverse and unfriendly. But did you see any discerning change in how investors approached IPOs vis-a-vis what we saw in previous years, where institutional investors or even retail investors, are they turning savvy, looking into profitability ultimately, rather than the liquidity that's been lifting everyone?
Yeah, so I think that all a part of growing up. So I think that one clear change that we have seen is that there was too much of hype around paying up for these new age companies, right? And and tendency to look into 2035 to justify the valuations that we are paying today.
Yeah.
And I think to some extent, institutional investors were also disappointed that as soon as the lock-in got over, the guys who were touting about 2035 were selling 1 year after the lock-in expired, right? So what it essentially means that there will be a reset of the valuation. Some of them are good companies. Eventually, they'll come back and they'll come back at sensible valuations. I think what SEBI has also done very clearly, we are very hyperactive in terms of our regulation norms. So if you look at the changes that they've made in terms of ability to speculate while having access to leverage funds, that has been dramatically cut, right? So you cannot now put in 100 crore bid and 1,500 crore bid or 200 crore bid respective to your net worth. That has been kept at 1 crore. So there is a democratization of that, which means that in the way I look at it is in India, IPO was largely process. कितना सब्सक्रिप्शन हो जाएगा, ग्रे मार्केट प्रीमियम कितना होगा, मैंने आज ले लिया बेच दिया. I think now that is reverting to a more fundamental outlook. Is a sense that at least I am getting. That is number one. Secondly, obviously, institutional investors become more demanding because how many companies will you own in a particular portfolio, right? So you need to have some sort of a moat to try and figure out why you want to own a company. But on net, I think it's good if the hype gets out of the market, you come back to sensible valuations, and the froth is away. So I think next year will be better in terms of the IPO outlook.
You mean the IPO valuations will be more reasonable?
Right. So what happens that if IPO valuation is more reasonable, then there's a fundamental basis to listing price, which means that investors make money. When investors make money, they come back again. So there's a cycle. You have gone through the other part of the cycle.
Yeah.
I think so. Finally, price is the biggest resetting of equilibrium. No.
Right. But you think the whole process of arriving at a valuation, or even what is the actual value and what is happening even after listing, was very difficult this year. For bankers, for investors. I mean, promoters really got the better of it because they exited somewhat. I mean, the exits that were given.
Possible, but a lot of this is hindsight. No, I mean,
very true.
We would not have expected Tesla to go from $1.2 trillion to $340 billion in 1 year itself, right? Or Zoom, we just discussing yesterday that actual usage of Zoom is below pre-pandemic levels. I had myself never even heard about Zoom in 2019. And I'm surprised that today we are actually using less of what you're using in 2019. So now you can argue that why is Zoom down 90%, but I mean saying is that is markets, no, that is a business risk. Right. So yeah, some of the promoters could have benefited, but by and large, I suspect that it is also a function of the markets and global valuations and relative valuations and stuff like that.
Right.
Yeah, I just like to add a couple of points that, obviously a lot of these were narrative driven stocks, and there's nothing wrong with that. People, there are firms which are investing in very early stage companies based on, 5-10 year outlook. But I think somewhere, both the factors were played against the, public market. One is the valuations at which these stocks came into the market. And secondly, they were all pegged to, a lot of them was pegged to, the new age stocks in the US, which were all propped up. The valuations were propped up because of zero interest rates. Now, both these factors have reversed. I think investors have sobered up, and we are not going to go back to a zero interest rate regime. Certainly not in the next 2-3 years. So I think, and the losses which have investors have made, certainly that is going to, make the bankers and the promoters, a lot more cautious in terms of how they price the IPOs. And I think that is a part of evolution, part of growing up, as Nirav said. And I think we expect, better performance from some of these IPOs next year.
Thank you.
Okay, I think we are done with all the questions. If there are more questions, you can send the same to us directly or to Whitemark Solutions. Thank you everyone for joining in. We will be sharing the press shortly with all of you. Thank you.
Thank you.
Thank you, guys. And wish you all guys a very happy new year in advance. Thank you.
Thank you, Nirav sir. Thank you, Sanjay sir. And thank you, everybody.